Our next guest says the government shutdown is hitting one real estate market in particular, driving up costs and creating some delays. For more on that story, let's bring in Don Peebles. He's the founder, chairman, and CEO of the Peebles Corporation, one of the country's most active privately held national real estate investment and development companies. Don, thank you very much for being here. You just heard Diana's report on some of the impact that we are seeing from investors and their sale and purchases of homes, also the looming government shutdown. What exactly is the shutdown doing in your mind to the real estate market in America?
Bringing a lot of instability to the marketplace. The market's already struggling because of high interest rates and also excessive vacancy rates for commercial office buildings around the country, and also lack of affordability in housing markets that are supply constrained and not enough inventory. So that combination of things is making it very difficult, and the government shutdown adds uncertainty and the inability to produce new housing. And I think those two things are really hurting the housing market in addition to the other elements.
In addition to those, are there specific areas, whether it be geographies or parts of the real estate market, that you think will be more severely impacted on a relative basis, given the shutdown dynamic?
Oh, yeah. Number one, Washington, D.C. The Washington, D.C. metro area, especially Washington, D.C. proper, is going to be devastated. It's already struggling with vacancy rates well into the 20s for commercial office buildings. Crime and cost of living and diminished quality of life has pushed people out of Washington, D.C. in terms of the housing market. And so you have higher vacancy rates in the housing market and prices on the downside there. And then the other element is Washington, D.C. has really relied so heavily on it being the nation's capital without expanding its marketplace in terms of attractiveness for businesses and entrepreneurs, and then a regressive tax policy. Those elements combined have made Washington, D.C. less attractive. If you look at Northern Virginia, it's being hit by the government shutdown because so many of the people who live in Northern Virginia work for the government. In addition to that, the government contractors, consultants, and so forth who are consuming office space. So that's also hurting that marketplace. But Northern Virginia is much more resilient because it's got better fundamentals, half the income tax rate that Washington, D.C. has, and a much higher level of public safety and quality of life. And so I would say, though, those are the two hardest hit.
One of the other places that's being played out right now in terms of a tug of war in the real estate dynamic on the residential and commercial side is the state of Florida. There are a lot of questions right now about just how sustainable the real estate dynamic is down there, given the extremely high-end real estate that happens down there that Robert Frank often reports on, 10, 20, 30, $50 million estates in Florida, versus some of the other types of properties, maybe more dated condominium type complexes. And then you throw in the cost for insurance and everything else. How exactly does the Florida dynamic shape up in your mind? And is there at least a bull case for still being in Florida right now?
Well, I think you've got to look at Florida regionally. So South Florida, which is pretty much what your monologue was about, is South Florida. South Florida, that's where you're finding the 30, 50, 75, $100 million estates. And so if you look at Miami Beach in particular, Miami Beach is almost the Monte Carlo or the south of France or Aspen of Florida or the U.S. And so what you have is it's very attractive for high-income earners, good quality of life, zero personal income taxes, zero estate taxes, and a very pro-business environment. And so you're seeing high net worth individuals, large businesses that are beginning to relocate a bit down there as well because of their economic and tax policies and quality of life. But you also have a declining inventory of new construction. That market for new construction of luxury condominiums is extremely supply constrained. On the flip side, you have existing buildings that are 15, 20 years, 25 years old and older, and those are being devastated by the marketplace. The market's rejecting them because of the exposure to major repairs and high assessments and high fees to cover that. Then you add the insurance cost for those kinds of buildings, and it makes it almost impossible for anyone to make sense to buy them. And I think the threat to South Florida in terms of growth of the housing supply is insurance. Now, Ron DeSantis did something pretty smart. He created what's called Live Work, which allows and incentivizes zoning where there is a 40% affordable or workforce housing component to address the desperate need of workforce housing. And I think that's one of the threats to slowing down South Florida. Now, the rest of the part of Florida, Central Florida, like Tampa and the Tampa Bay area, that's doing really well, slowed down, but still affordable. Jacksonville, still affordable. Daytona Beach, still affordable. West Palm Beach, Steve Ross is building an entire community there. He's doing a great job there and attracting businesses and entrepreneurs and young people. And I think you'll see some growth there, and that's still affordable. So Florida's got a mixed bag.